We are seeing a major sell-off across North American equities. Let's give you a live look at what's happening in New York. The S&P 500 is off more than 1.2%. The tech-heavy NASDAQ down more than 1.5%. This as investors raise concerns on the slowing in that fight against inflation. The latest U.S. inflation numbers came in hotter than expected, and it suggested to some that this jump into rate-cutting mode by central banks like the Fed, even the Bank of Canada, could be a bit premature. And speaking of Canada, the decline we're seeing at this hour of more than 280 points, or more than 1.3%, if we were to close at these levels, it'd be the worst day so far of 2024. So let's get some more perspective. Christine Tan is a portfolio manager at Sun Life's SLGI Asset Management. This is one data point which the market is reacting to, but what does it say to you about what's going on right now?
Morning, John. It says that this market is priced for perfection. We after the rally we saw in December, you had the bond market basically pricing in a lot of cuts. The stock market kind of pricing in almost this perfect Goldilocks scenario of the economy is not going to slow down dramatically, but on the other hand, financial conditions are going to ease. So there was just a lot of, I don't want to say positivity, but optimism that was priced in on both sides. So today's data, you know, it is a little bit hotter than expected. You're seeing the reaction in the bond market. But again, at this point in the cycle, it's normal for data to be noisy. I don't think it really changes what the Fed's been saying. They've been pushing back on the bond market for several weeks now. And what's interesting is the bond market's kind of pulling back a little bit, because at one point, 6 cuts, now down to 4 cuts being priced in.
I do want to talk to you about that, but I guess there's a look at the 10-year yield. We'll come back to that story. Let's look at the TSX. How do we look at a 12-month for the Canadian stock market, which might give us a better sense of what Christine is talking about? So call it October lows, Christine. We have seen the benchmark in Canada, even with the pressure today, rally between 10 and 11%. So are you saying this is in some ways recalibrating, reassessing as much as anything else?
Absolutely. We think that a lot was just pricing in a very short period of time. The reality is that, yes, inflation is coming off of post-pandemic, post-lockdown highs, but the pieces of inflation that are still sticky are not going to be easily solved, especially in Canada, housing. Even in the U.S., the CPI data this morning, it was slightly hotter. It was mainly OER, owner's equivalent rent. So those are not fast-moving components, and those are components that are going to be remaining quite sticky.
Okay. And for the stock market mood to stay bullish, is there something, let's say a little bit of reassessment has already just taken, quite literally just took place this morning in the market. How does the stock market and interest rate story play out from here? In other words, is this, because this is a very complicated story, if the economy is doing relatively well, and I know everybody's got a different opinion, including an opinion on Canada versus the U.S., but the economy is relatively resilient and inflation is not out of control, it's just not quite where central banks would like it to be, so they're going to be slower to cut rates. It doesn't sound like a disastrous environment for investing, does it?
No, absolutely not. And exactly what you're trying to get at is the crux of the question. So the way the stock market performs, it's a function of earnings and what you're willing to pay for the earnings.
Right.
And what you're willing to pay for the earnings is directly linked to bond yields, because if bond yields are higher, then your PE multiples of valuation on stocks have to come down. And that's basically the reaction you're seeing today. It's more of that bond yields up, so stock multiples have to come down. What could hold the markets in, both on the TSX or S&P's earnings? So if we continue to see spectacular earnings out of some of the big, this Magnificent Seven, or maybe now it's the Awesome Six, or whatever
Tesla's
the moniker is.
Yeah.
Exactly. That could hold the S&P in. For Canada, it's a different story. We've been through a pretty tough earnings season period, several earnings season in a row now. We're still, I think the expectations consensus is for Q4 to decline 4% year over year, but that's much better than the quarter before, by the way, which was down 11% year over year.
Okay, so the note against that backdrop, the note that you shared with our producer was you're somewhat constructive on fixed income versus equities.
Yes.
Now, the trick with the fixed income market, it's supposed to be, you know, steady Eddie, put it away. It's been pretty wild out there. But when you sort of send us a message, it's a good time to be looking at bonds. Quantify that. Like, what does that mean? How should we think about fixed income investing right now?
Yeah, so you kind of need to take several time horizons, if you will, because this is the number one question we've been getting from our clients. Is it time to, if we've been in money market or GICs, which a lot of Canadians love and have done well in, is this time to look at bonds? And we say, it's going to be volatile, which is what we're seeing today, because you're still in this sort of push and pull between when is inflation getting back to target. But if you look at where interest rates are today, so 5% in Canada, there's actually, on an inflation-adjusted basis, there's actually a pretty attractive real interest rate now. So there's room for cuts even just to normalize rates as inflation comes down, even if we don't get a slowdown in the economy. Now, is it one way down, as we're seeing today? No, there's going to be continued volatility. But if you sort of zoom back out to a longer time horizon, government bonds in Canada and the US are the highest they've been since the Great Financial Crisis. So that's kind of a longer term perspective to say, if you're a long-term income investor, if you need that yield, this is an interesting time to be sort of picking away at it. Is this the absolute bottom? Like, are bonds only going to go up from here? No. You're going to see continued volatility.
Okay.